This is Ben Asra from Matrix Macro, and I am privileged to talk with you regarding the implications of tariffs on the global economy. By looking at the historical accuracy, we have to go to 1930s to look at how things were, you know, evolved in that period between different nations. Because in 1929 we saw that the U.S. had Great Depression, and most of the countries were maintaining gold standard. It's nothing but picking their currency to gold. So instead of letting their currencies to float and altering their economy based on the external circumstances, these countries were picking the gold and accumulating gold, thinking that the gold can solve a lot of their problems. But the John Maynard Keynes has virtually attacked this model, and Britain in 1931 has devalued the currency by abandoning the gold standard, and after that we can able to see that the unemployment in Britain has reduced and the export market has picked up in the 1931 and to 1933. So these are the small history. So right now we have to see that the US is waging a trade war with a lot of nations, especially China. So China is having a very unusual time at this stage, but Chinese are prepared than what we have seen in 2018. They have retaliated with tariffs as much as the US does. Apart from that, the Chinese exports to the US is around 500 to 550 billion dollars, which is a small peg, around 13% of its 13 to 14 trillion dollar economy. So it's not a big deal for the Chinese to deviate that surplus to other countries. But the caveat is the Chinese are importing a lot of manufacturing goods from the US. So it takes a lot of time for them to get that surplus, get that manufacturing surplus from the United States technology supremacy. And the Chinese are also restricting the export of rare earth metals for the US jet and engine manufacturing, like that. So these are the complications, but we have to talk about the big picture here. So even when you look back at the history and looking today, we know the tariffs are deflationary. So the US dollar is selling down, US treasuries are selling down. So it's definitely a confidence game that's going up in the financial markets. If you look at the currency market, the dollar has been sell off, is real sell off for the last 1.5 weeks, and we could see the higher liquidity euro is ripping up higher. And I was looking at the I was looking at the market right now, thinking that how much the dollar can go down. So probably it will go to 90. The index would go to 90. Probably it will stay at 95. Who knows? But the implications of the tariffs are deflationary and the recession. So many economists are predicting that the US will go towards recession. So they have downgraded the GDP growth for the full year from 2.1% to 1.4%. So it's around 0.6% to 0.7% points. It's going to be very tepid for the US. So as long as Trump is trying to doing this, it's going to be costly for the US and the China, because Chinese can divert it and they can able to sustain, because China is an autocracy and the US is a democracy. So these are the major political themes that we have to see. And apart from that, I could argue that the Chinese model has been heavily articulated towards export model. So the Chinese will definitely export. We have bilateral trade relationship. They may invest a lot of capital into their domestic infrastructure and other investments, so that they can jack up GDP growth. They can manipulate whatever it may be. With respect to the US, there has been some kind of criticisms coming from the business community, especially from Wall Street. So that's why the Trump administration has put off a 90-day deadline for this implementation of tariffs. And it's going to be a very very unusual time for the US also, because we have to see how higher prices will be looked after by the local people in the US. So they will be They will be highly uh, going to be angry at the US administration that's governing the country right now. So what we are looking at is that when there is deflation, people would definitely go to long bonds. So it's going to happen. But here is the thing: we don't know which is where the long bond trade is happening, because right now it's happening in Europe, in all countries, Asian countries, in the Middle Eastern countries, because people are pulling capital from the US. So US has to maintain its fiscal prudency with the help of foreign investment, especially from China, Japan, and others. So if these folks are pulling capital away from the US, it's going to be detrimental both for the United States and for these, capital pulling countries like Japan and China, particularly. So we are not definitely at this stage, but we are looking at the prospect of, you know, uh, traders unwinding the U.S. Treasury's position from the U.S. bond market. So that's why the Treasuries are moving up, and it's going to be a interesting thing in 1 or 2 weeks that what Trump administration is going to do with the tariffs regarding the effects of it. So yes, friends.